The letter comes on a Tuesday, regular envelope, the same logo in the corner you've been looking at for 11 years. Inside, one page, your renewal. And down at the bottom, a number that's bigger than last year's number. So you read the explanation paragraph, because there's always an explanation paragraph, and it says something close to this. Due to increased costs in your area and rising claim severity, we have adjusted your premium. That's it. That's the entire explanation. Increased costs, rising severity, your area. Now sit with that for a second. You didn't have an accident. You didn't get a ticket. You didn't move. You didn't buy a different car. It's the same car it was last year and the year before that and probably the year before that. So what exactly is your area doing that costs so much more? Nothing. Your area didn't do anything. The thing that raised your premium didn't happen in your area. It happened at a port about 14 months ago, and it has been walking toward your mailbox ever since, one desk at a time, one signature at a time. Today, I'm going to walk it backward with you. Every hand it passed through, every place the number changed, until you can look at that letter and know precisely what you're holding. I'm Ellen. I spent about 30 years inside the American car business, the engineering side first, then the analyst side, where I read filings and contracts for a living. This channel is where I read the fine print out loud, so you don't have to. If that's useful to you, subscribing is free and it's the only thing I'll ask for. That's the whole pitch. Back to it. Let me start with the two numbers that this entire story lives between. The first number is 1%. That's what Insurify, a company that pulls from a database of well over 100 million real auto insurance quotes, projects the national average full coverage premium will rise this year. From $2,144 up to $2,158, $14, nothing. Statistical noise. If that were the whole story, I'd have made a much shorter video. The second number is 4%. That's the same company's projection for what happens if tariffs actually push repair and replacement costs the way the supply chain says they're going to. Same analysts, same data, one condition changes, and the forecast quadruples. 4% of $2,144 is roughly $86 a year, and I can already hear somebody saying, Ellen, $86, that's a tank of gas? Fair. Honestly, fair. If that were a one-time hit, I wouldn't spend 20 minutes on it. But that's not what a rate increase is. A rate increase isn't a bill, it's a new baseline. Next year's increase gets calculated on top of it. And the year after that, full coverage premiums are already up 43% since 2021. Nobody planned that either. It just compounded, one supposedly modest adjustment at a time. And here's the part that makes this year genuinely different from the last four. Prices went down in 2025, 6% nationally. Real relief for the first time in years. 39 states saw rates fall. Wyoming dropped by more than 20%. So the story isn't just your bill went up. The story is that the bill went down briefly, and now the thing that's about to push it back up has nothing to do with anything you did. And most people are going to blame themselves for it, or blame their zip code, or blame their neighbor's teenage driver. Let's find out where it actually came from. Now, to do that, I need to tell you something about how insurance companies think that most people never get told. And once you understand it, half the mystery in that renewal letter evaporates. An insurance company does not price you based on what is happening. It prices you based on what already happened. That's not a criticism. It's the mechanical reality of the business. An insurer cannot legally charge you a rate it invented on a hunch. In every state, it has to file that rate with the state insurance department, and it has to justify it with data actual claims, actually paid, in actual dollars. Actuaries call this loss trend. Plain English, how much are we paying out per policy, and which direction is that moving? So picture the pipeline. A parts price rises. Body shops start writing higher estimates. Insurers pay those higher estimates on claims. Those payments land in the claims data. The actuaries wait for enough of that data to be credible. You can't file a rate change off one bad month. Then they build the filing. Then the state reviews it, and the state may take its own sweet time and may push back. Then, once approved, the new rate applies to policies at renewal, not immediately, at renewal, which for you might be 4 months away. Add all of that up, and the industry's own rule of thumb is 12 to 18 months from cost increase to your mailbox. 12 to 18 months. Now go back and look at the calendar. The tariff on imported automobiles took effect on the 3rd of April, 2025. The tariff on imported automobile parts and parts are the ones that matter for your insurance, so hold on to that distinction. Took effect on the 3rd of May, 2025. 25%. That comes from a presidential proclamation, number 10,908, issued under Section 232 of the Trade Expansion Act of 1962. I'm not going to argue about whether that's good policy or bad policy. That's not what this channel does, and frankly, it's not what will determine what you pay. What determines what you pay is the plumbing. May of 2025, plus 12 to 18 months. That lands us right about now. The bill is not coming. The bill is arriving. It left the port 14 months ago, and it's been in transit through the system this entire time. And the reason nobody warned you is that in the moment it happened, it didn't look like it had anything to do with you. It looked like a trade story. It ran on the business page. All right. Let's actually do the arithmetic, because I don't want you taking a percentage from me on faith any more than you take it from an insurance company. I want you to be able to check my work. Here's the chain, and there are only 3 links in it. Link 1, roughly 32% of the auto parts sold in the United States come in from Canada and Mexico. That's about a third of the parts on the shelf. Link 2, when your car gets fixed, parts make up about 60% of the repair bill. Labor and everything else is the other 40. Link 3, your full coverage premium is really 2 things bolted together: liability, which pays for what you do to other people, and comprehensive and collision, which pays for damage to your vehicle. That damage side is about 60% of what you pay. Now, run the numbers. A 25% tariff on a third of the parts supply. A third of 25 is roughly 8. So call it an 8% lift on parts costs if the whole thing gets passed through. Parts are 60% of the repair bill. 8% of 60% is about 5% on the repair bill. Repairs drive about 60% of your premium. 5% of 60% is about 3% on your bill. 3%. And then you add the second effect: imported vehicles got more expensive too, which raises what an insurer has to pay out when it replaces a car instead of fixing it, and you land in that 4% neighborhood. That's the whole trick. 25% at the border becomes about 4% at your mailbox, because the tariff gets diluted 3 times on the way down. And I want to be honest with you about the direction that dilution runs, because it cuts both ways. It means the sky is not falling. 4% is not catastrophe. Anyone selling you catastrophe on this is selling you something. But it also means something more uncomfortable. It means a tariff you never voted on, at a port you'll never see, on a part you can't name, still finds you. It always finds you. The chain is long, but it isn't broken. That's not a conspiracy. That's just arithmetic, and arithmetic is patient. Now, let me stop and argue against myself, because I promised you I'd do that in every one of these, and because the number I just walked you through has a serious hole in it. 25% is the headline rate. It is not, for most parts, the rate anybody actually paid. Parts that qualify under the United States-Mexico-Canada agreement, the trade deal that replaced NAFTA, can come in exempt, or close to it, if the importer can document where the content came from. And they have. In January of this year, close to 85% of imports from Canada and Mexico claimed a USMCA exemption. The effective tariff rate on that flow came in under 5%, not 25, under 5. There's more. Automakers assembling vehicles here in the States got an offset, a credit calculated against the sticker price of what they build domestically. It started at 3.75% of that aggregate sticker value and stepped down to 2.5% on the 1st of May this year. Vehicles and parts from the European Union, Japan, and South Korea settled at 15% total, not 25%. The United Kingdom settled at 10%. So if you're keeping score honestly, and I insist on keeping score honestly, even when it dulls my own story, the real, paid, effective tariff on the parts in your body shop is meaningfully lower than 25%, and my clean little arithmetic overstates the pressure. Good, that's the Steelman. The importers and the automakers would tell you exactly that, and they'd be right. Here's why I still think the 4% is the number to watch. Because the exemptions are documentation, not physics. They depend on origin paperwork, on audits, on which parts qualify, and the list of which parts are covered is not fixed. The Commerce Department runs a quarterly window, January, April, July, October, where domestic manufacturers can petition to add new parts to the 25% list. Accepted petitions go up for public comment, then a decision. Every quarter, the net can get wider, and nobody sends you a letter when it does. That's the mechanism, not a plan, a ratchet. So let me now walk the money, hand by hand, because this is the part that never gets covered, and it's the part that tells you where the leverage is. Hand 1. The importer pays the duty at the port. Not the exporter, the importer. An American company writes that check. Remember that, because it's the most misunderstood fact in this entire subject. Hand 2. That importer sells to a distributor, and the duty is inside the price now. It stopped being a tariff. It became cost of goods. Hand 3. The distributor sells to a parts wholesaler, and the wholesaler doesn't just add the cost, the wholesaler adds a margin on the cost. That's how markup works. A percentage of a bigger number is a bigger number. Hand 4. The body shop buys the part. And the body shop is where something quietly ugly happens. Shops have started pre-buying, stockpiling common parts ahead of price increases. That ties up cash the shop would otherwise spend on tools, on techs, on the lift that keeps breaking. So the shop's cost of doing business rises on two axes at once, and the labor rate follows. Hand 5. Your insurer pays that repair bill. A repair that ran $4,200 a few years ago is running toward $5,800. Now, those are real figures from body shops, not projections. Hand 6. That payment enters the loss data. It becomes a data point in a spreadsheet, and it will sit there for months, quietly, while the actuaries wait for company. Hand 7. The filing goes to the state. The state approves it or trims it. Hand 8, and that's you. That's the Tuesday letter. 8 hands. And in not one of those 8 rooms did anybody sit down and say, let's raise Ellen's bill. Every single person in that chain did the ordinary, defensible, boring thing their job required. That's what I need you to understand about how this works. And it's the reason I get frustrated with the channels that turn everything into a plot. There's no plot, there's a pipeline. And a pipeline doesn't need a villain to reach your door. It just needs to be pointed in your direction, which it always is, because you're the last hand. You're the one with nobody to pass it to. Now, the part I actually made this video for. Because if you keep your vehicles a long time, and I suspect you do, since my own car is 12 years old and I have no plans to replace it, this next piece hits you harder than it hits anybody else, and almost nobody is telling you. Rising parts prices do not primarily raise your repair bill. They raise your risk of not getting a repair at all. Here's the mechanic of it. When you file a claim, your insurer runs a comparison. On one side, what will it cost to fix this vehicle? On the other side, what is this vehicle actually worth, the actual cash value? What it'd sell for today, in its condition, with its miles? And most carriers set a threshold. When the repair estimate climbs to some percentage of the vehicle's value, they stop repairing and start writing a check. Your car is declared a total loss, sometimes on a car that drives just fine. Now watch what tariffs do to that comparison. The repair side goes up, parts cost more. The value side does not. Your 12-year-old truck is worth what it's worth. Tariffs on new imported vehicles don't put a dime into the resale value of a 2014 pickup with 140,000 miles on it. So the two sides of that comparison spread apart, and the threshold, which used to be comfortably far away, starts getting crossed by damage that would have been a simple repair 5 years ago. Just over 23% of auto claims now end in a total loss. That's a record. Picture it. Somebody backs into your front quarter panel in a parking lot. Nobody's hurt, the truck starts, it drives, you take it home. 2 weeks later, the adjuster calls and tells you, in a perfectly friendly voice, that they're totaling it. And he means it kindly. He's not the enemy. He's reading a number off a screen. And then he tells you what the check is for, and you sit there and you do the math that everyone in this situation does, which is, what can I actually buy today with this check? Not that truck. Not a truck like that truck, because the used market went up too. That's the real cost of this, not $86 a year. The $86 is the visible part, the part on the letter. The invisible part is that the machine is now slightly more likely to take your paid-off vehicle away from you and hand you money that won't replace it. And for a person whose independence is parked in the driveway, that's not a line item, that's the whole thing. Let me be very careful here and separate what I know from what I suspect, because that line matters more than anything else I say today. What is confirmed? The tariffs exist, the dates are documented, the parts tariff took effect on the 3rd of May, 2025. Confirmed. Insurance pricing lags cost increases by roughly 12 to 18 months, by the industry's own account. Confirmed. Insurify's projection moves from about 1% to about 4% if repair and replacement costs rise the way the supply chain indicates. Confirmed. Total losses are at a record share of claims. What is not confirmed, exactly how much of the tariff actually lands, because the exemptions are doing real work and because the covered parts list keeps moving. Anybody who gives you a precise number to the decimal point for your specific policy is guessing. I'm not going to do that. And what I flatly reject, the idea that somebody designed this to take your car. Nobody did. The tariff was aimed at manufacturing. Your premium was collateral, and collateral is the most honest word in this whole video. Aligned incentives don't require a plan. They just require that nobody in the chain has any reason to stop. All right, let's look at the receipts. And let's talk about what you can actually do, because I don't do videos that leave you scared and empty-handed. First, and this is the one nobody tells you, you can read your own insurance company's rate filing, yourself, for free. There's a system called SIRF, the System for Electronic Rate and Form Filing. It's run by the National Association of Insurance Commissioners, and most states publish their approved filings through a public portal at filingaccess.sirf.com. You pick your state. You search by company name, business type, property and casualty, personal auto. You open the filing. Inside, there's a page called Rate Information. It shows the overall percentage change the company asked for and the percentage the state actually approved. There's also an actuarial memorandum where the company explains, in its own words, to its own regulator, why it needs the money. Read what your insurer told the state, then read what your insurer told you. It's a genuinely educational afternoon, and it's the single most powerful thing a policyholder can do, and almost no policyholder ever does it. Second, if you want to watch the tariff side, the parts list moves through a docket on regulations.gov. The docket identifier is ITA, then 2025, then 0040. That's where the petitions to add new parts get posted and where the public comment periods open. You don't have to file anything. You just have to know it exists. Third, 3 questions for your insurance agent. Write them down. Question 1. Does my policy require original manufacturer parts, or does it permit aftermarket and recycled parts? This matters enormously right now because a policy that allows recycled and aftermarket parts is a policy with a cheaper repair estimate, which means it's a policy less likely to hit the total loss threshold. There's a genuine trade-off in that. Understand it before you need it, not after. Question 2. What actual cash value is currently on file for my vehicle? Because that's one half of the comparison that decides whether you keep your car. Question 3. Has a rate change been filed and approved in my state that will take effect at my next renewal? They can answer that. And now you know how to check the answer yourself. Fourth, shop the policy. Every single renewal. Not because loyalty is bad, because loyalty is invisible to the pricing model. Remember, rates fell 6% last year, and a big part of the reason was that carriers were fighting each other for customers. That fight is still happening, but it only pays the people who show up to it. Fifth, and I'm going to say this one carefully, because I'm an engineer and an analyst, not your financial advisor, and I'm not going to pretend otherwise. Raising your deductible lowers your premium. It also means more of your own money on the table when something happens. Whether that trade makes sense depends entirely on whether you have cash sitting behind it. Same with comprehensive and collision on an older, low-value vehicle. At some point, the coverage costs more than it can ever pay out. That is a real conversation worth having with your agent. It is not a decision to make because a person on the internet told you to, including me. So here's where we end up. Somebody, somewhere, in the spring of 2025, signed a document about steel and engines and factories. It was a manufacturing decision. Maybe a good one, maybe not. That's an argument for a different room. But documents have downstream, and this one traveled. From the port to the distributor to the wholesaler to the body shop to the claims file to the actuary to the state regulator, and it took 14 months. And it arrived on a Tuesday in a plain envelope with a paragraph that told you nothing. They didn't raise your rate because of you, but the letter is addressed to you, and it always will be, because you're the end of the line. That's what being the last hand means. The only thing that ever changes that arrangement is whether the last hand knows what it's holding. Now you do. Go read your filing. If this was worth your time, subscribe. I put one of these out when the documents give me something real to work with, and I'd rather have you here for the next one than not. Take care of that car of yours. It's worth more to you than it is to them.